Good. Okay. Anyway, thank you for all this discussion.
Yeah, of course, of course. I love talking. Like we said in Madrid when we met in Madrid with my wife. I love talking with you guys and think of you guys as friends
And
now.
and
So,
one last question was about the coaching session.
uh-huh.
That if we will start again, because I work and I go even to university. Uh, if we do like which time can be available to you, like in the my late evening is okay for you, or in the early morning?
What time is it there now?
Like because I was thinking the late evening I will be really really tired
Yeah,
after all 10 years of work or in. So now it's almost 3 o'clock in the
3
afternoon.
p.m. So okay, so you're what? How many hours? It's 9 a.m. Almost 9 a.m. here. So about 8 hours ahead.
I think
So
you are in Tampa, right?
yeah. So I mean, most as long as I have advance notice, I can work pretty much whatever works for you. I just need advance notice.
No,
Uh,
we will do like we'll do a schedule like
yeah.
they will more or less be the same all the time. That's better for me and
Yeah.
for you.
Typically,
So,
typically mornings or early afternoons are best for me.
but okay, but early morning for me is even better for me. But I don't know if it's better for you. I mean, if
So
it's
early
good for you.
morning. What time are you thinking?
Like 6 o'clock.
6 a.m. your time.
Yeah,
So that'd be like
because after
10 p.m. my time.
10 p.m. But I don't know, 10 p.m. is too late here. So.
Yeah, the kids are back in school now, so I have to wake up early to take them to school.
Okay, so we cannot do 6 a.m.
No.
No, so we should do in my late. Okay, so we should do in my late night.
We'll figure it out. I'm not worried about it. I'll figure out something that works for both of us. So,
Yeah, maybe someday that school doesn't go to the kids. Sorry, doesn't go to school. I don't know. We have to find like
yeah,
free time.
yeah. Yeah, we'll find a time.
Mm-hmm.
I'll
Mm-hmm.
work it out.
And
So,
the real last one was like the price that we set it was just so that I know because I can make a budget for everything.
okay, yeah, I'll let you know the total, the back total.
Okay, if you send me an email when you finish.
Yeah,
Okay, thank you,
we'll do.
thank you, thank you
Um,
very much.
of course. David said waiting for takeaway food to come up. We'll be in soon. Okay, so let's start recapping. He'll be in here shortly, and we'll just
Okay,
talk
sure,
now about stuff that him and I talked
sure.
about last time. So let me
Mm-hmm.
know when you can see my screen.
Mm. Okay, I can see it.
Okay, so you're familiar with this, right?
Yeah.
So let's go all the way back. What what is your familiarity with capital allocation?
Which one of these?
No,
In,
just capital allocation in
okay,
general.
in general, like capital allocation, it's uh, it's a real critical point in every company and even in managing my others people money. Like for example, if you have a fund or a hedge fund, because at the level of hedge fund, maybe it's more clear that someone has the the goal. I mean, as their job is to allocate the capital that other people give to them to get something in exchange that is a return on their capital that they are giving to him. but it's the same the same thing actually happens in a company, because inside in a company there are the managers have to know what to do with the capital that they eventually will make from the company. So a company is an endeavor that the goal of a company is to make money in the end. So they have a revenue, they have cost of sales, they have expenses, they can be fixed or variable, and in the end they have the net income after they pay the taxes. So they have to know what to do with this net income, if to put this net income again in the company or pay out as dividend. If they put again in the company, so they will retain the earnings. So they will retain a part or 100% of what they make. They have to be sure that these retaining earnings will not just be in the cash balance and so accumulate a pile of cash, but they have to allocate that capital as a fund manager will do. In the same way, they have to allocate this capital at the best return for the shareholders. So if they can, like, for example, buy new instruments or spend for some kind of special advertising that can they can put up the revenue, so they can grow the revenue with all strategic initiatives that cost money. And if they can do it at a good return, better than what of course the bank can give you on that money or in general, so they should invest buying like a machine or they have invest in the company. Otherwise, if they cannot, if they find that their company is a mature stage or it's not at a stage where can still scale up, so if they see that their business doesn't need another money, or if they invest other money, that money it's more than what the business needs to scale. So they will have a return on equity that will be lower than what they would have had if they give away this cash as dividend, or maybe in some cases they can even buy back the stock of their company, only in the case the stock of their company is really undervalued. So in that case, they will still allocate capital in a good way, as the same as a hedge fund manager will buy a stock in a company because it's undervalued.
Very good. Very good. So to sum up, so you're pretty much, you still should go back and watch that video because we go into more depth on these topics.
Yeah.
David and I do. But yeah, you have everything perfectly. Only things I would add is the term you were looking for when you're talking about the excess cap, the retained earnings. A simpler way to think about it, in my opinion, is excess cash flow.
Yeah, excess cash flow.
Because when you bring up retained earnings to somebody, they looked at you like, and then you have to explain what retained earnings are and all that stuff. So that's generally a simpler way to think about it, in my opinion. Hey, David, we're just recapping last week right now. You haven't missed anything.
Hey,
We're just recapping last week right now, so you haven't missed anything.
okay, cool. How you doing? How you guys doing? Go see ya.
You guys too.
Bye. Thank you.
So the other thing is my definition of capital allocation or proper capital allocation is putting your capital towards its best, highest, safest return use. That's my personal definition of capital allocation. So what is capital?
Mm-hmm.
You say use an example of a hedge fund. David.
Yeah.
Last week we talked or was it 2 weeks ago now? We talked significantly about what is capital. So what is capital outside of just money? David, do you remember? Or what do I consider capital outside of just money?
Something valuable to you.
Yes. So something valuable I can exchange, or that you can exchange,
Or something else.
or value from somebody else. So that goes down to
Yeah.
time, relationships, skill, knowledge,
Yeah.
money, of course, capital. It's all of these things. What I view capital as is not just money.
Okay.
It's
So
all
for example, my work, if I do something in dentistry, I exchange what my know-how for money.
yes.
So that's
yes, exactly.
Okay, it's capital.
Yes, exactly. Well, another way to think about it is time as well. And this, to me, on a personal level, is super important because I have kids and a wife. So should I spend more time with my wife and kids? Am I spending enough time with my wife and kids? Am I spending enough time with my wife and kids for myself so I don't drive myself crazy and think I'm a bad dad, bad husband?
Yeah.
Am I spending enough time getting new clients? This kind of stuff. It's thinking about capital allocation in terms of just everyday aspects of life has helped me enormously. So, for example, years ago, I cut out almost 100% of TV.
Yeah, me too.
I could spend more time doing this kind of stuff, so I could spend more time reading and learning, so I could spend more time getting clients, so I could spend more time with you guys, so I could spend more time with my wife and kids, so I can spend time coaching my kids' soccer teams, all that kind of stuff, because I value that more as a priority than watching TV. So a good point David made when we last talked about this was essentially with capital allocation, you're prioritizing what you think is best for you. Let's say we're talking about you personally, or you're prioritizing what is best for you at that point in time.
Yeah. Okay.
So should I watch TV or should I read and learn? Should I watch TV or should I study dentistry in your case? That kind of thing. So to me, and again, we went over this quite a bit in the last video, so I'm just kind of wrapping up here, but you should definitely go back and watch that video because we talked in depth about these kind of situations. In depth, I think, David, we talked for about an hour and a half, hour and 45 minutes just about capital allocation decisions, and a lot of that was on personal, like one-to-one level. We didn't talk about, we talked about business scenarios, but most of the time I think we spent talking about things like relationships and how you spend your personal time and all that kind of stuff. So that is a very, very quick wrap up of what most of we talked about last time. So again, I highly recommend going back and watching that whole video. And I will do it. I put it in the chat for you so you could watch it.
Yeah, I already opened the page.
Okay, perfect. Good. So now I'll recap these quickly. So these are what I see as the 7 stages of capital allocation at this point in time, based on my knowledge and experience and learning about these kind of things and experiencing these kinds of things over the last 12 plus years, evaluating thousands of companies, learning from people like Warren Buffett, Henry Singleton, Charlie Munger, Tom Murphy, and others. These are what I see as ways to think about how to invest your capital. And these are in order, but you don't necessarily have to go from step 1 to step 2. You can go to step 1, think about step 2 if you want to, and then if you decide not to do it, go to step 3. Does that make sense?
Not so much. You have to focus before on the internal options of the company and after on the external options.
So yeah, it'll probably help if I go through this. So first off, and these are in a specific order, because first off, you should invest in you should think about your internal options first. Why? Because you are more familiar with the company, you're more emotionally involved in the company, you should know more about your company than outside people do.
Yeah, exactly.
So, and you should know where you can improve things like efficiency, marketing, stuff like that. So it should be easier to focus on internal operations first. Plus, if you do that and you do it well, you gain more cash flow that you could then use at the other stages to invest more and build your snowball faster.
Mm-hmm.
So, number two, after that, and that could take months, it could take years for companies to go through, or there's companies that for literally years or decades continually focus on their internal operations. The company I use as an example, last time we talked about this, was Toyota. They are always looking for ways to improve efficiency, improve profitability in their internal operations.
Mm-hmm.
But at some point, you should probably at least consider looking outside of the company. So this is why the expand outward one has a question mark. Should you even do that?
Mm-hmm.
That's why there's a question mark there. You should consider it at some point after you get a lot of efficiencies and profitability out of your own business. But should you do it after you consider it? So that's where you're looking at things like expanding geographies, buying outside companies, doing joint venture partnerships, expanding your product line outside of your current knowledge base, those kind of things. Then there's stage three. Investing excess capital at the highest, best, and safest returns.
Excuse me, but for external options, you mean just like buying other companies? Because expanding the geography is still something that you do internally. Like, okay, it's not like that you grow the efficiency of your company, making the same product, all this kind of stuff. But you still are using your same product, but just trying to sell that to dealers that are in another country. So it's still something internal, I think.
Yeah, no, and some of these overlap a little bit.
Okay.
In that example, thinking about expanding geographies, let's say from Italy to Spain.
I think I saw that as internal options.
Yeah, and it is. But you're still going to a different geography that you probably never dealt with before. So it's still external in my opinion. But again, some of these overlap.
Mm-hmm.
So yeah, no, good question though. So investing excess capital. This is where things get more interesting. How should you invest that capital? Should you go back to stage one and invest internally in internal operations? Should you expand marketing, sales, operational capability, finance capability, knowledge, hiring more people? Should you expand outwardly, new geographies, new product lines, new services, whatever? Should you look at a different asset class like investment real estate or another private business or XYZ, whatever the case may be? This is where things get very complex very fast. And as you'll see in the doc that I'm going to show you after I'm done doing this overview of this, David, you saw this a couple weeks ago. Stage one, part one, these concepts get very complex very fast. So I'm going to try to keep things as simple as possible, but things get very complex very fast even when you just consider stage one. So this is where people are bad at capital allocation, or if they even know anything about it, is because the complexity is enormous in each one of these stages. So what I'm going to try to do is simplify this for as much as possible for you guys. So here is where we talk about proper capital allocation and why it's so important. There was a study that I read that said proper capital allocation can 20x returns over time. So increase returns by 2,000% over time with great capital allocators. And I just, I don't know if it's released yet, but I just made a video the other day about comparing actually Brickworks, David, that we did a case study on, and Berkshire Hathaway, and how Berkshire Hathaway did what I deemed as proper capital allocation. Brickworks did not. And Berkshire's returns in that time are 110x in excess of Brickworks. They started about the same time period. They transitioned out of their main line of business at about the same time, but one did proper capital allocation and one did not. And Berkshire 110x'd their returns in terms of Brickworks. So that's a perfect example. Okay, stage 4, using other people's money, like this is investment flows. Accounts payable that you haven't paid, insurance float, unpaid premiums, those kind of things. And we'll talk more about each of these stages later when we get to them. Compounding capital over time. Compound interest is, I think Einstein said, the 8th wonder of the world. And if you continue to allocate capital well over the long term, it will explode your results. Okay, here's what I call it, stage 6, the snowball effect. Creating ever more cash flow by investing your capital well. If you're doing it well, you should create ever more cash flow, which you can use to invest in other assets that should produce more cash flow. And then you can repeat the cycle over and over again to make more and more money. And that's how Buffett built Berkshire from $100,000 initial investment from when he started his partnership to $530 billion. Repeating this process over and over and over again. And then number 7 is just repeatability, repeating everything over and over and over again. Do you guys have any questions on this, specifically Matteo? Do you have any questions on this before we get to the actual stages?
Yeah, like I think that when you're talking about investing excess capital and external focus, like if external options are buying other companies, all this kind of stuff, and what you are left with is investing excess capital, I think not so many companies will have. I think that every company can use as much as they want all the money. It's how they use that money. Like having in excess capital to invest in other companies or for other reason, I saw most to something like Berkshire Hathaway. I don't know if you can understand me. I mean, like a company that produce, for example, something that can help you to check if your truck is all safe. I don't know, to check if something is breaking your truck. Okay, you can maybe buy another company that makes some pieces that can add value to your company, but only if you can buy at a good price, and many times you cannot. And at that time, even if you have so much free cash flow, and a part of that you are investing in your company, not just to keep the maintenance level, so to keep your company at that level, but even to increase your revenue. But you see that if you invest even more, much of that will be just waste. So in that case, or you give the money back as dividend, or you buy back the stock in the case you can, or you should do something that you are actually not, that's actually can be your job, but the people can see as it is not your job. So doing what Warren Buffett was doing, taking all that money and reinvesting in another company, in another industry that doesn't have any correlation with your company, creating an holding. But in that case, you will have to specify that to the clients, maybe to the shareholders. It's something a little strange for a company, even a small company. Actually, the small company have much more free cash flow than big company. And so I don't know, like, for example, I see many companies that can produce a lot of free cash flow. Maybe they can use just part of that free cash flow to expand their business. And it's even wise way to not use all the free cash flow to expand their business, because maybe much of that will be waste. And the other part, if they don't give back as dividends, what they will do? They should allocate that capital as a fund manager will do. So use that capital to invest, to buy other company in the public market, in the private market, but just a part of the company, of course, not all the company, because that's another kind of job.
So here's what you're getting at. And this is why I was smiling when you were talking.
Yeah.
This is where the complexity gets really complex very fast.
Yeah.
If you don't have excess cash flow, you need to build it. But how should you build it? What is actually excess cash flow? What should I spend that excess cash flow on if I really have some? How do I measure my returns on that excess cash flow investment? And so on and so on and so on.
No, but my thing is, if you have a lot of cash flow that you can use a part to expand your business, and maybe it's not necessary to use all your cash flow to expand your business, because maybe it's not the kind of business that you can scale so easily, or because the business is not that you just put 1 million. You need to have a strategy. So maybe sometimes it's better to scale a little bit at time, so you can use a little bit, like 30% of your extra cash flow, to scale your business, to grow your revenue. And maybe the other cash flow, what you will do, you will give back as dividend. You will pile up cash that it will not be okay for your shareholder, because you are not creating value in that case. And so what you have to do, you should invest in some other company in the public market, but that's another kind of job for that. And that's what Warren Buffett was doing. He was famous for.
Yes. So should I invest all of my capital? Should I invest 75%? Should I invest 50%, 25%?
That's the big question mark. I mean, you should invest what you think can give you the maximum results.
Yes. So here's what I normally tell people when I'm talking with these companies is, if you have excess cash flow already, let's say they have excess cash flow already, so we don't have to worry about building profitability, efficiency, all that stuff. Let's say they have cash flow already. In my opinion, they should put some into a savings/cash account for emergencies.
Emergency, yeah.
Yeah, equipment breaks, you need to hire somebody, a recession happens, whatever.
Yeah.
Put some in there. After that, you should invest it. But how much how should you invest it? How much should you invest it? Where should you invest it? So that's where it depends highly on the business model, highly on what you're doing. And
on the industry in which you are.
Yeah.
But the problem is not even that, because, that's really difficult. But after you figure out that, what you will do with the rest?
What do you do with the rest of the capital?
Yeah, if it's a company that doesn't have someone that is great at capital allocation, it's not their job, they don't have someone like you, for example, that can help them to allocate that capital, what they will do with the rest of the money, what they should do.
What should they do is far different from what they do. Most people invest it internally on stuff they've always done, just because they've always done it, even if it's not getting them a good return. Well, first of all, they probably don't know what the return is. Second of all, it's probably not getting as good a return as they think. So they're not as investing it as their highest rate of capital or highest rate of return. Secondly, if they do know anything about capital allocation, which most people don't, me and David talked a lot about this last time we talked, is most people don't know anything about capital allocation, because they started their business to have freedom, to help people, because they had specialized knowledge, that kind of stuff. They don't know anything about this. So, and this goes all the way up. One of the companies me and Shafiq are working with overseas, or trying to work with, is a $50+ million company with operations in India and the UAE. They don't know anything about this. So this, I mean, unless you're in the billionaire stratosphere, most people
Mhm.
don't know anything about this.
Yeah, but so what they will do with that money?
So what they will do most of the time is they'll leave it in a cash account. They'll pay dividends, even if they shouldn't be paying dividends. Or they'll invest internally. Or they will look to buy a company because they're bored or because they want to expand or whatever.
Why you said they should not pay dividends? If it's better to pay dividends than to waste money buying other companies without a sense, without a thinking behind, without buying them at a reasonable price.
Generally, yes, but on a dividend, you're getting double taxed. You get paid.
Yeah,
you pay tax on the net income, and then you pay tax on the dividend.
I know, but still, it's best than waste money just on a wrong acquisition.
Yes. So this is where, yeah, you have to really know what you're doing, and if you don't, I can guarantee you 99% of the companies in the world are wasting money because they don't know what they should be doing. They're just kind of doing what they've always done or doing what they think they should do, even if it's not getting them a high return.
So what they should do is having someone that can take care of that money, invest in other companies, so manage that money as if it's a fund, no?
Yes. So in my opinion, yes. Because this is a very specialized skill set and mindset and knowledge and takes a lot of discipline and patience. This is why Warren Buffett spends the majority of his day every day for the last 30, 40, 50 years reading, learning, and thinking about capital allocation. He runs a $530 billion company with 27 people in his headquarters office. Because he has managers that run these companies, the CEOs, whatever they are, the founders, whoever, running these companies.
In fact, when you think about that's true. When you buy a company, there is already a management there.
Yeah.
And he's the first one that say, I don't want change management.
Yeah.
I want a company where the management is already good because already proved themselves. You cannot go around with an entourage, for example, and just say, okay, you manage this, you manage that, you know, it would be crazy. So what differentiates Berkshire Hathaway from all other holding companies or companies in general is that he was like clear about the fact that to say the company, keep what you need to grow at an healthy rate, not even too much, at a healthy rate, no, without making debt at a healthy rate and with something that makes sense, and give me all the rest. And they will invest in other companies that doesn't have anything to do with your company too.
Yeah. Or if he sees a great opportunity internally in one of these companies, he might invest in them more, put more money in business.
Okay.
Or he'll do a bolt-on acquisition for one of these businesses. So not necessarily a full-on acquisition, but a bolt-on acquisition like a service line or a part or a product.
So they even help each other. So for example, if one of that company needs more money, don't do that. So I can give you the money.
So for example, to my understanding of how Berkshire works is exactly what you said, but I would add one thing to it. It's exactly you take what you need to grow at a healthy rate. You send the rest to me. But if you need money, if you need capital, and you can show me that it's going to get a high return on capital, I will give you, say, $1 billion to do that.
If you?
What was that?
No, I don't understand the last part. If you,
like, let's say one of his companies wants to expand or buy another competitor or whatever. If those managers can show to Warren Buffett that they will earn a high return on capital or have a high probability of earning a high return on capital, he will say, here's $1 billion, do what you need to do. But they have to show him that it's going to be a good acquisition or a good investment or whatever.
Okay.
So essentially what he does is he takes away what is excess, but he will give it back if you can show that it's going to be a good investment, a return on your investment.
Okay, so he will even give more in some occasions.
Yes.
If that's the case. Okay.
Yes.
Okay. So yeah, it's all about capital allocation in the end. Managing a business, even a small business, is all about that.
Yes. So here's where we
Oh,
get to a lot more of the fun stuff. So here's the model I've been building out.
Holdings. Okay.
David, you and I spent about an hour and a half, hour and 45 minutes talking about stage 1, part 1 last week, correct? Or 2 weeks ago, correct?
Yep.
Matteo, I sent Matteo the video. He said he's going to watch it so we can start here this week. Matteo, if you have any questions on this part, either message me or David or just put it in the group, Facebook group.
Okay, I
And
will
we can talk
message.
about it. Because
Maybe we can do a WhatsApp group. It's easily for me. Like
yeah, because this is frankly super important. So again, we spent an hour and a half talking about it, and we kind of just barely scratched the surface. So, but for today, we're going to start here. Before we do that, though, here is the entire model as it currently stands. So 5 pages, 1,234 words as of this point. But I'm constantly learning and adding things because, for example, this entire section in part 1 wasn't here until after we had last week's meeting, or when we last talked about capital allocation. And then I went back and watched the video, and I realized I forgot to add some stuff. So I'm constantly adding to this as I learn more and more. So let's go back up to here, though. Simplification. Make things as simple as possible, but no simpler. That's pretty much what I try to do with you guys every time we talk. I try to take these super complex subjects and make them as simple to understand so we can all understand them, because if you understand them at a simple level, you won't just understand what I'm talking about, you understand how to use them and how to think about them in your own lives or in your own experiences, whatever. A business example of simplification. These companies I'm working with overseas, or me and Shafiq are working with overseas. Let's say the one in the heavy equipment engineering arena, contracting arena that we're working with. They have different business lines. They have the heavy equipment and machinery that they sell and rent and use on their projects. They have the engineering part where they do the actual engineering, and then they consult as well. Should they be focusing on one of those business lines? Should they be focusing on a different business line, like an adjacency? If they should be focusing on one of their business lines, how can they make it simpler, easy to understand for the employees, for the clients, for everybody involved? The reason this is important is because the more complex things get, the harder it is for everybody to understand things. That means more inefficiencies. That means more potential errors. That means higher costs because you're spending more time fixing errors instead of actually making progress on the deal or on the job. That means lower profitability. That likely means lower revenue as well. Does this all make sense?
Yeah.
This is it should be one of the easiest things to do, is to simplify things, but it's generally one of the hardest. Do you guys have a guess as to why that is? Let me rephrase before you answer that. It should be one of the easiest things for people to do, especially if they're business owners and they know their company intimately, but it's also one of the hardest things for them to do as well. Do you have a guess as to why?
I'm guessing there might be a lot of conflict of interest.
Give me an example.
Well, if you stop, paying your salary to the staff, they're going to be pretty pissed off, even though the best thing is to fire staff.
Yes. Yes. That's a perfect example. So let's say you have too much staff. If you're a smaller company, I think this company has 30 employees. If your company has that few employees, you're likely very close or pretty close with all of them. You probably treat some of them or most of them as friends and many of them as family. If you come to the realization that you need to fire somebody, that's going to make you feel horrible. If you treat them as a friend or family, make you feel absolutely horrible. And most people, even firing people you don't necessarily like, is horrible. It's not fun.
Yeah.
So that's a perfect example. A real world example of this is what Matteo and I were talking about in cutting out TV. That simplifies what I am doing on a daily basis so I can concentrate on things that I value as a higher priority. That is a real world everyday example of simplification. The one thing I would add to what you said, David, is frankly, if you're a CEO in a small to medium to even large size business, you don't generally have the time to take a step back and look at actually how complex everything is that you're doing. You don't have the perspective of, wow, I've built this company from $1 million to $100 million and it's so complex, I don't even know what's going on half the time anymore. Uber, years ago, went through this in the book. I think it's called The Upstarts. They talk about Airbnb and Uber and their kind of rise to power. They went from pretty much nothing to $100 million billion dollar plus company like that. And their operational ability and their profitability, well, their non-profitability magnified because of how complex things were until they purposely worked to simplify things. This can be insanely powerful if you realize that hey, we're getting too complex here. We need to simplify things. We need to build systems. We need to train more. We need to cut stuff, whatever the case may be, to simplify things, whatever makes things easier. But you have to realize, first you have to be able to realize that there is an issue. And most people are just stuck in the grind of working 8, 10, 12, 15 hours a day, and they're constantly going. They don't have the perspective to be able to do that. Does that make sense?
Yeah.
Okay, so this one's a lot more straightforward than this one. But you have to think about these stages at each layer of business. So David, we talked pretty in depth about making small, consistent improvements in each line of your business pretty much constantly, correct?
Mm-hmm.
If you have the perspective and you can take the time to simplify things, you need to do that in each line of these business as well. So how do you prioritize that? How do you measure its return? Let's say you're thinking about cutting a business line because it's unprofitable. Fine. Are you going to sell the business? Are you going to fire everybody and just cut your losses? Are you going to take time to try to get the business more profitable by simplifying things, by training people better, by implementing systems? You should think about all of these things, because it affects, again, not only the people, and in a small business, your potential family or friends or people you treat as family and friends. It can affect your operations going forward as well. If you make a wrong decision and you simplify too much and you cut something you shouldn't have, it can destroy your business. So should I cut this? If so, why? If so, what kind of return can I expect to earn investing this cut capital into another business line? Would it increase profits and revenues? Would it increase cash flow? How do I know this, and why am I thinking this? Am I being emotional about this? All these kind of things come into play. Matteo, do you have any questions? Because again, we covered a lot of this stuff in the last. So if you have any questions, let me know.
No, but I understand it's like the lean manufacturing principle, like to make everything more simple, more efficient. But that's not easy because maybe you can cut some people, like some salesmen, because you see that they are maybe too many for this kind of revenue, this kind of of stage of the at this stage of the company, but maybe soon after you will have your revenue that will grow up, and so you have to hire after other people in less time. I mean, it's not easy to find the perfect equilibrium when you want to. I mean, I think that it's normal to spend money on marketing and not be 100% efficient on that. But the principle behind that it's correct. Of course, it's that you have to think how you can maximize your return on these costs. In the end, these are cost of sales, cost of operations. So we have to think twice about that if something is really necessary or not. But I think that
there's also something you have to think about. This brought something to mind. Sorry to cut you off. This brought something to mind. Is there's also the law of diminishing returns. Should I continue working to simplify things, or am I going to earn a high enough return if I simplify something, or should I spend my time and effort and energy somewhere else? For example, cell phone.
Mm-hmm.
Everybody in the world pretty much has one of these now.
Mm.
Before cell phones, smartphones came along, we had to have 20, 30, 40, 50 devices to do what one cell phone can do now. It was made to simplify people's lives, and it has to a large degree. But it's also an added enormous complexity as well, because you can literally get lost on your phone for days if you want to. So you have to kind of gauge the effort, or not the effort, the benefit and cost of your simplification as well.
Exactly, of the simplification, yeah.
Because sometimes you can simplify too much, but you add a million more problems.
No, that's true, yeah.
So, any more questions on that? David, any questions on that?
Open.
Okay, so what time is it? We've already covered in about 30 minutes the recap, or the brief recap, and one more stage when we talked about just this one stage last time. Efficiencies. Part 3. No, letter A, to me, is even more important than earning the highest rate of return on capital. Because if you cut expenses that harm your future profitability and value increases in your company, what's the point? It's like, hey, I'm going to cut off my hand because I've got a broken hand, but then you have no hand on this hand, or then you have no hand on this arm, and you're without a hand. So you have to make sure, and this is where people, if they do know anything about capital allocation, this is where accountants are typically very good about finding places you can cut costs.
Yeah, it's true.
But they don't tell you if the costs cut are going to harm future business prospects. Because I mean, anybody, if you even know a little bit about financial statements, if I were to give you a private company financial statement, you could go through it and say, hey, they should probably cut costs here by 10% or whatever. But then, would that harm future business? You have to think very, very seriously about that. Very seriously. When I went over to Dubai the first time, I saw I got their financial statements before, for this company, I got their financial statements before I went over there. So I knew pretty much what I was going to talk to them about. Then we went through the conversation and we found out that their cash flow problem wasn't necessarily a cost problem. It was a not getting paid problem. They could cut costs to a small degree, but they weren't getting paid from their contract, or they were getting paid super late, like 6 months late. So that is the main thing that was causing their cash flow constraints. When originally I thought it was because their costs were too high. So you have to be very, very, very careful, because if you cut, let's say, because during a recession, one of the first things to be cut typically is marketing, right?
Mm-hmm.
Because people don't think it's bringing a high enough return, blah, 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 whatever the reason is. You should probably do more marketing in a recession. Why? Do you have a guess as to why? If you have the capital to do it and you're a reasonably healthy company, you should probably do more marketing in a recession. Why?
Because I think that everyone is cutting there, so you will be the only one. It will be cheaper to do advertising.
Perfect. That's exactly right. Plus, everybody is cutting back, so you can build market share easier as well.
Yeah, it will cost less to build more market share.
Yes. So if you are in a healthy position, almost everybody in the world is cutting back. If you have the capital and the financial strength, which you should build before the recession comes, but if you do, you should do even more marketing for those reasons. So you don't, in my opinion, if somebody cuts marketing, either they're not thinking about it from the long-term perspective, they don't have the capital to do it because they're not financially healthy, which again is a really bad sign, or they don't know what they're doing.
Because it doesn't make sense, yeah.
It doesn't make sense. The marketing, if you're not marketing as a business, people don't know you. And if people don't know you, they won't do business with you.
At least I think you can start, I don't know, taking a statistics about what are the top 10 products and start with reducing the production of the other, so you will have less inventory.
Yes.
But not cutting, and focus the advertising more on the top products, but not doing the opposite, so cutting the advertising to not cut the production, because you have to have the priority. The first priority is advertising. The second is the top products that you still keep producing, because if you sell a lot of that during the year, there is something behind that. And third, we have the products that are less sold, so you can start with cutting that.
So, great points. But here's where some of the layers of complexity come in. Let's say you have 80 products that you're selling. You should have an idea, or you should know what you're earning the highest return on. Know what your highest sales maker is. You should know what your lowest sales maker is.
Exactly, yeah.
You have 80 products, just based on statistics and probabilities. I can guarantee that probably 20 of them are either making zero money or losing money, unless you're some gigantic company. So should you even be investing in those at all? Should you cut those?
Yeah, you should cut even before.
Sell them off.
Yeah.
And if you do decide to do any of those, where should you put the excess capital from those divisions? And here's another thought that just popped in my head. If I'm not going to cut them, how am I going to get to a position where they are profitable? How can I and how will I get that product to where it's profitable? If not, you need to cut it.
Okay, you can start with reducing you can start with trying to make your margin higher on that same product.
Yeah, so, which is essentially raising prices or cutting costs, or both?
Cutting your costs and remain the same price for the product, so to have a so to have a bigger gross margin if you can. It's the first thing. But this is about like even the profitability. Because if you think just about the product and you have to start even to reduce the price, I don't know how much is worth to still produce that product.
Exactly.
You have to see. You have to see, because if it's something just about the gross margin, you have to focus on improve that.
Yes.
If it's about sold unit, I think that I will just don't. I mean, if I have other product that goes better, why keep spending my money and my time on that kind of product that is not solving so much?
So great point. We're on point B now. Is it worth my time? Is the most important thing of what you said there.
Yeah, exactly. It's not worth even my time.
If you have a decent business, you can always produce more and more cash flow or more profitability, more revenue if you need to. But is it worth my time?
My time in even, I think if you have a customer service, the time of the customer service. So it's better to give better customer service to the product that I sell the most. And even in the advertising space, I will advertise more that product. And maybe because I sell more that product, I can even try to increase the margins on that top product.
Yes.
So
here's a real world example from my personal experience on this. Years ago, I used to sell stuff on Amazon, like candy and what else I could, puzzles and games and toys and whatever else I could find that I could earn, essentially arbitrage. I could buy it and sell at a higher price on Amazon. In no circumstances would I sell something that had a really low sales rank, because it would take forever to sell, and my fees would be enormous, so it wouldn't be worth it. In no case would I sell a product that had less than a 4.5-star rating, because then people would get mad and then they would leave me bad reviews, and then less people would do business with me. Because it's like eBay. People buy stuff based on your reviews and your score. So those wouldn't be worth my time or effort or capital to invest in those assets, even if I could make money on them.
Yeah.
So the reason I said the cutting expenses, and let's say you have 80 products, is Paradise Inc. I think I sent you guys this article a couple months ago.
Maybe, yeah.
Where I wrote and I evaluated every single one of their SKUs on Amazon, and found that like 20 or 30 of them were getting no sales whatsoever. So why even sell them? Why even put in the time and effort to sell them if you're not selling them?
Well, yeah.
That's another real world example of where you could cut costs and immediately, even if it's not saving you that much money, it definitely is saving you time. Definitely saving you time, which is increasing profitability, increasing efficiency, all that stuff. So all these.
Yeah, because still we'll have some employee that some employee that has to manage that division. So you pay the wage and you have to check that other division full time, especially for a small business.
Yes.
Anyway, it doesn't make sense even for a big business. In fact, you can see that big business try something. If it doesn't work out, they cut out.
Yeah. Well, this is what Jock Welch at GE did. Essentially, if you're not number one or number two in your industry, they got sold or closed or cut significantly. Okay. Any questions on any of this? These are, and then again, you have to think about these at each individual product line, each individual service line, marketing, sales, operations, finance. You have to think about all of these in each. So let's say, and we talked about this last time we talked, David. I'll just go over this briefly for Matteo. If you're running things well as a company and you're the CEO, you should have somebody running the marketing department, running the sales department, running the operations department, running the finance, running HR, running all these different departments, and making these decisions for you, if they know what they're doing in terms of thinking about capital allocation, which again, most people don't. So if you as a CEO delegate these jobs well and you hire people that are good at doing them, you can spend your time think about or helping them figure out where we should cut expenses, where we should look to without harming the business, where we should simplify things, where we should implement systems. You should think about more big picture things as a CEO if you're doing things well.
Yeah.
And again, that's very hard because most people come from operations or finance or HR or marketing or sales or whatever. They come from one of those divisions. So when they automatically go to CEO, they are biased likely towards one of those divisions and want to help out more there than thinking about big picture things. And I don't know if you guys will fully understand this because you guys aren't, well, I think Australia is a little bit about American football, but Italy I don't think is at all. But in American football, a head coach usually comes from the offensive side, defensive side, or what's called special teams side of the business when they get promoted to become a head coach. Sometimes, or it seems like the best coaches will focus on kind of the big picture stuff and then delegate these other things to their coordinators, what they're called. Their offensive, defensive, special teams coordinators. So they can handle those. They might still occasionally help with kind of building the strategies and plans in those arenas, but they focus on the big picture strategy more, or they should. At least the best ones do. Does that make sense? Even though, again, you guys don't have football over there or American football?
Oh, yeah, it makes sense, yeah.
I was trying to think. Go ahead, David.
Just totally random, but when you went to Dubai, did you know that they have a different sort of like a financial system? They have something called sukuk or something.
Mm-mm.
But it's like a Dubai bond, and you know how like in Islamic law you can't they don't charge interest, like
Yeah.
there's like a because my school right now is Dubai owned, like the school I'm working at is Dubai owned.
Oh, really?
It's publicly listed on the Nasdaq index or something. And then they sell sort of like a bond. It's like a weird instrument that's sort of like it's like a half equity, half bond thing. Yeah.
Remind me we'll need to have a session on that because that's super interesting.
Yeah.
Is that? We'll have a session, okay.
Yeah, no, that's super interesting. Have you started working yet?
Next week.
Oh, awesome. Have fun with that. Congrats.
Wow.
Yeah, gonna be very busy. It's all good. It's all good. Looking forward to teaching kids. The school's quite interesting. For about 600 students, they've got rooms to grow for 2,000. It's a private company. It's probably mid-range international school. It's really funny how like in Asian country or like you know how like international school has this prestige. And not many parents want to send their kids to local school. Yeah. And so the international school is like literally like a premium. And you'd be surprised how much money the parents put toward this kid's education. I don't know if it's really justified, but the growth is like massive. Like they're building a new apartment, a new like classroom. You can fit like 3,000 students here. It's crazy.
That's crazy. That's becoming more popular even in the U.S. Not necessarily the private schools, but the charter schools, the magnet schools, the what are the other ones? The sports, I think they're Avid schools or something like that. Where they focus on. There's a school that focuses more on sports and athletics. There's different kinds of schools coming to the United States, but they're still mostly public schools. I think there are some private ones like that, but they're still mostly public here. But they are becoming more popular. For example, charter schools. Just since I've lived here. Almost 4 years now. 4 years in October, I think. And they've built and or are building, I think, like 12 charter schools just in within a 25-minute driving radius of where I live. It's insane. And my daughter, actually my two oldest daughters' school, it's a kindergarten through 8th grade. They have almost 1,200 students in that school alone, which is just absolutely insane. I think my high school, which again is usually bigger, you have more people in a high school. Obviously, this is a smaller city, but I think I had 600 kids in the entire high school. my graduating class was like 120 people.
What about you, Mateo? What's been happening? Is he looking for an apartment or something?
Yeah, I was looking for an apartment, as I told before to Jason. Some apartment to rent, but it's not so easy. Actually, in Milan, it's crazy, the market here. They are going up and up and up, the rent, and it's really not easy to find something affordable that is nice. And actually, they want to make these, I was telling to Jason, these 4+4 contracts, like 4 years that you can renovate for another. So you have to contract with them and say, okay, let's put that I can finish this before like giving 3 months advance to say that as warning letter that I will leave the apartment. Because actually the law say that you have to give 6 months of advance.
Dang, that's crazy.
Warning, and you need something that declare that you are finishing your study or you bought a home, something where you say, okay, I will leave before the 4 years because I have another home. So it doesn't make sense, for example, or I finished my studying. So now I am contracting with some other people to put in the contract that I can leave without any reason because I don't want, to be too much attached to a place legally.
David, I had the same reaction as you when he said that. That's crazy.
You see?
I mean, in the U.S., as long as I think most rental contracts, it's either 2 weeks notice or 30 days notice. So to have 6 months notice, that's insane.
Yeah, that's insane, man. In Malaysia, 2 months.
In fact, I don't understand. Like, if I don't know, for example, I can get, if I was an engineer and I go around the world for work and maybe I stabilize in Milan for 2 years and after they tell me, okay, if you accept this kind of job, in 1 month you have to be in Dubai. How can I leave the home?
Yeah.
I should pay for what I don't use. It's crazy, no?
I think and a lot can change in a month, let alone 4 years.
I think in the United States it makes much more sense. But the contract is for 1 year, 2 years. For how many years it is?
That's crazy.
No, but Jason, for how many years is the contract? Okay,
in the US?
Yeah.
It's either month to month here or a 1 year lease.
Or 1 year.
Yeah, no, I frankly, I don't think I've ever heard anything over 1 year.
Yeah, I haven't either. Malaysia, 1 year, extend 1 year.
Yeah, I think that's how you do it. You can agree to extend it longer if you want, but it's typically a 1 year.
Okay, if you want, okay. But and it's crazy even from the point of view of the landlord, because if I have an apartment and I give to someone with the 4+4 years, when we finish the 4 years, he can say, okay, I want other 4 years because it's already in the contract. To kick him out, you need some very good argumentation.
That's crazy.
So that's crazy. Yeah.
I wouldn't want a bad tenant for 4 years.
But I think that they should change this law because actually now with I mean, you can see that everyone change work from one place, from one city to another, from one country to another. So 1 year, it's okay, but more than 1 year, it's useless as contract. I mean,
yeah, that's crazy.
And 50 days notice, oh my God. Oh my God. Amazing.
That's crazy.
Yeah. And I don't know, but they ask you like guarantee that you have a salary from some place that is like, that lasts more than 10 years, this salary, like some kind of this
10 years?
Yeah, they want a salary that is, or a limited time, all that has to cover all the period that you are there.
Jeez. I mean, they make sure you're making enough money here, but they don't go 10 years back.
Like enough money, like, but even if you are a freelancer, you can just take your like tax report, say I make this money, and you say okay, right?
Yeah, pretty much as long as you don't have like an eviction, you don't have any felonies, and you can prove that you're making income that's more than what they require, you're pretty much good to go.
But prove without having like a contract with some government, like, and I mean with some government, like a contract with a restaurant that has for. I mean, if I am a freelancer, you will accept me the same?
It depends. Typically what most people do here, if you're a freelancer and you don't have tax returns or you don't have a long-term work history,
exactly.
they'll make you pay more up front, like a bigger deposit up front type of thing. But typically, as long as you have the money, most people around here don't care.
Okay, so for example, you give 3 months in advance, something like that.
Yeah, something like that. Yeah.
Oh my God, it's so much easier though. They want the money in advance the same year, even if you give them the contract. Even if I put my parent as guarantee that he has a contract with the hospital that is without limit, no? Even in that case, they want 3 months advance as like, if you break something, okay, but we still have a contract. If I break something, I have to pay. I mean, you know, doesn't make so much sense because it's a contract. It's not just, I don't know, 2 weeks holiday in some place.
Yeah, that's crazy.
Can you sign a contract with someone else?
Yeah, can you assign the contract?
I can sign the contract just if my parents are like will be as guaranteed.
So they'd be screwed if you wanted to move out.
What?
So they'd be screwed if you wanted to move out.
They will be screwed. I mean, I don't know because my parents are so. I don't know. Well, that's crazy, you know, it's completely crazy. Because even if you work, it's...
Yeah,
I cannot have a 10-year track record.
Yeah, that's nuts.
I think, man, I swear the market must be hot in Milan because if you start doing 4-year contract in Malaysia, people will be like, fuck that, I'm just going to find another landlord.
Yeah. Same here.
Yeah, it's about the law too, you know.
That's crazy.
Yeah.
Hot market, probably. That's what I'm guessing.
I've got a meeting at 10:30, so we got about 15 minutes left. So I want to hit this one, and then we can just talk or whatever. Okay. So we've talked about efficiencies, simplification, and making small, constant improvements. Next step that you need to think about is profitability expansion. Continually working to increase your profitability margins. ROIC, FCF to sales, operating margin, ROC, and unlevered return on net tangible equity. Those are, to me, the ones that are most important for pretty much every business. Unless it's like a financial services, like an insurance company. These are the most important metrics for most businesses out there. If you have all of these metrics above the numbers that I state here, you're what I deem to be a good to great business. Very few, probably less than 2% of companies in the world have margins on a consistent basis that reach these levels. So what do you do to improve those things, to get to those numbers? If you can get to those numbers, what do you do to do that? You concentrate on the things above and the things below.
Mm-hmm.
Why are these specific numbers? Why are they not necessary, but why are they optimal to have?
Yeah, I mean, because there is enough growth. They are using, well, the equity, because it's return on invest capital, so it means they're using well the equity and the debt. They have free cash flow, so that's good, because something is the net income, the operating income, other things is the free cash flow. The operating margin, even that is good to have an operating margin that is above 10%. I mean, it's still good if you have some kind of operating margin. That kind of operating margin is really good. So even the unleveraged return net tangible equity, you mean like to calculate how much debt they have, right? How much they can make without debt.
No, we'll go over net tangible equity next time. I'll make sure to calculate that for you, because I don't think we talked about that. I know it's in the course, but I don't think we personally talked about that.
Okay.
So I'll go over that next time. What if you have numbers consistently above these? It means not only are you good to great business and elite category, it also means you have more excess cash flow you can use to reinvest to earn higher returns on capital. Gives you a larger margin of safety. It means you don't have to take out bad debt or issue bad equity at bad terms. And it means you grow the value of the company efficiently. If you're growing the value of the company just by taking out more and more debt, that's not good.
Okay.
If you're growing the value of the company by issuing equity over and over and over again, generally that's not good, unless you have an overvalued stock.
But you cannot see that from here about that you can issue equity.
You can't what?
You cannot see by here that if you are issuing debt or equity more.
No, these don't measure those, correct.
Okay.
But if you have these traits, it makes it more likely that you're a healthy company that has a large margin of safety.
Okay. That's for sure, yeah.
It makes it more probable.
Mm-hmm.
It also gives you options. Because if you are producing consistent margins above these numbers, again, you have excess cash flow. Excess cash flow gives you options. You can invest more in internal operations. You can invest in expanding operations. You can invest in buying other companies or assets. You can, and if you earn higher returns on that capital, it compounds more and more and more and more, which gives you more cash flow, which gives you a bigger margin of safety, which grows the value of the company. This is why Berkshire Hathaway has $120 billion in cash or whatever, which is just absolutely insane. $120 billion in cash. And he's looking for something to buy and he can't find something to buy. But it gives you options. He has the option to buy if he wants to, if and when he wants to, if and when he finds the right opportunity. If you don't have that excess cash flow, let's say Berkshire instead only has $10 billion in capital for a $530 billion company. That's not a lot. So if your subsidiary company's running into issues or a recession hits that drives profitability and revenues and all that lower, $10 million isn't a great backstop for that size of a company, but $120 billion is. Does that all make sense?
Yeah, it does make sense.
Do you guys have any questions on any of this so far?
Yeah, I don't remember anymore. Return on invested capital, it means equity plus the operating margin on net income on equity plus debt, all the abilities.
No, it's operating profit divided by EBIT, EBIT, divided by equity. I think I'm going off the top of my head. I think it's equity minus cash plus debt, I think is ROIC off the top of my head. So what essentially you're looking to find there is how profitable the profits you're creating compared to your operating profits and the use of equity and debt and cash.
And debt and the capital employed.
That is more, so the first one is based on those kind of financial metrics. Return on capital employed is more based on hard assets like property, plant, and equipment, inventory, accounts receivable, that kind of stuff.
Mm-hmm. No, the capital employed is about?
Yeah, return on capital employed right here.
Yeah.
Yeah, that's more hard assets.
Okay, but how you calculate that one?
I think it's
Because if I don't remember well.
yeah. Hold on, let me find it. Total capital, EBIT divided by total capital employed, and capital employed is total assets minus current liabilities. So you're essentially gauging the entire balance sheet here, or most of the balance sheet here.
That's instead it's so equity minus liabilities. No, plus liabilities.
Equity plus debt and debt equivalents minus cash and cash equivalents and other investments.
Okay.
So here you're measuring it against the how well you use your financial instruments. Here you're gauging most of the balance sheet.
Mm-hmm.
And then even further, this one is unlevered return on net tangible equity is this one is the hard assets. Accounts receivable, inventory, PP&E, expenses. So they're just different ways to measure how well you're using your balance sheet in terms of financial instruments, in this case, hard assets, or for the ROCE, most of the balance sheet.
Yeah.
You guys have any comments on any of this?
No, it's everything. Yeah.
Sorry, this one was a little bit more rushed. Shafiq messaged me yesterday, and we have a potential buyer that I need to talk to at 10:30. So that's why I moved the time up 30 minutes, and that's why I have to leave a little bit earlier than normal.
Okay.
No worries.
Cool. Anything else, guys?
No, it's everything.
All right. Matteo, make sure you go back and watch the last video. I go really in depth about stage one in this. But after that, we should be able to go faster on these now for the most part, because in the first stage, I talk a lot about the individual business lines or in terms of the operations, finance, those kind of things. All of these apply to each one of the business lines as well, each individual product, service, business line, whatever. So now that we have that initial stage in mind, we should be able to go a little bit faster on these things.
Yeah, that's okay. So we see next Sunday?
Possibly. I might be in Dubai next Sunday, depending on what Shafiq and I figure out about another buyer, about a different buyer. He wants to meet on this coming.
Okay, that's great. Okay.
So I'm not sure if I'm going or not yet, though.
Okay.
Yes, we'll do. And I'll try to let you know earlier in the week this time instead of the day before, but I didn't find about this until yesterday. So.
Okay, cool.
All right. Cool, guys. Awesome to see both of you. I'll let you know about next week. And yeah, if you have any questions, just message me. So.
Okay. See you. Bye-bye.
And I'll get this video up later today as well, later today or tomorrow in the group as well.
Yeah. Okay.
All right, guys.
See you.
Talk soon.